Hey guys, this is Andrew from Dividend Growth Masters. So a few weeks ago, I put out a video regarding selling cash secured puts to generate passive income on stocks that you already want to own. And in this video, I want to go over four different tips on executing that strategy. So the first tip on selling cash secured puts is selecting your duration, the duration of the contract. Do you want to go short term or do you want to go long term? So typically, I what I like to do is I like to focus on data decay. So data decay is one of the primary Greeks, one of the option Greeks, and basically, as time goes by, an option is worth less because there's less time for it to be exercised. So as time goes on, the option will decay, meaning that it will get less and less valuable. And that's really what we're capturing when we're selling options. So the thing you want to consider is short term options generally have a lower option premium. So let's look at Amazon as an example. So Amazon is currently trading about $92.50. So if we look at the $92 put for 3 days from now, December 16, 2022, it's trading at about $1.56. But if you go 10 days from expiration, that same option will be $2.27. So it's roughly 60 cents higher. And if you go even further, say 17 days, then it'll be $2.71. So the closer you get to expiration of the option, the less it'll be worth. So typically, what I like to do is I only like to select options that are going to be expiring within typically 10 to 20 days. I find that that's basically where the highest data decay is. So that allows you to capture the most data decay, basically get the most bang for your buck when you're selling options. Of course, you can also go out longer. You can go out even, let's say, 200 days out, and you can also sell that same option. But generally, for those ones, there's a bigger risk of it being exercised or at a there's a bigger chance of it being assigned to you. So I typically like to sell between 10 and 20 days from expiration. Again, that'll allow you to have the highest data decay and capture the most value within that time period. The second tip I have for you is what to do when you might be assigned an option. So basically, when an option can be exercised, it's within the strike price. Basically, if the if the option holder exercises their option, you will randomly be assigned. You may be randomly assigned the option by your brokerage account, meaning you'll have to buy those shares from whoever exercised them. Now, there are generally two ways to avoid it. One, you can just buy back the option before they exercise it, close out the position. But being assigned the shares under the cash secured put strategy isn't necessarily always a bad thing. First of all, like I mentioned before, if you set the strike price at a price you're comfortable paying the shares at, then it's really not that big of a deal. Basically, you got paid to buy the shares at a price you really wanted to pay. So it's really not that big of a deal. But let's say you do get assigned your shares. What do you do then? So let's look at this example again for Amazon. Let's say you sold the $94 put, and now you're being assigned the shares because the stock fell to $92.53. So in that case, you're going to buy 100 shares at $94, and that'll be under your account. So the option will go away, and you'll just have 100 shares of Amazon. In that case, basically you have there's a few things you could do. The first is you could just hold the shares, just go long Amazon. The second thing you can do is begin selling covered calls on your Amazon shares. So you bought them at 94, it's trading at 92.53. So basically, you can sell the call option. So you can sell the $94 call option for December 16th at $1.15. So basically, if you sell the covered call on your Amazon shares, you're gonna make $100. But then that comes with more some risk as well. If Amazon shares increase back, to 95, $96 a share, then you'll lose a little bit on the upside from the upfront premium that you generated. But being assigned the shares is not always a bad thing. You could always just go long the shares or begin selling covered calls on the shares that you were assigned with the puts. The third tip I have when you're executing a cash secured put strategy is to try to only sell your puts on down days. That is when the market, the S&P 500, the Nasdaq, the Dow, when those indexes are down. And the reason I typically like to do that for put options, that is because that's when volatility is the highest. So when the market goes down, say, 1%, 2%, or 3%, then the volatility index, the VIX, will spike up. And volatility is basically one of the most important inputs in options pricing. So when volatility goes up, option option volatility goes up and option premiums go up, which means you'll be able to sell your options for higher prices. So if you're executing a cash secured put strategy, try to only sell them on down days. And finally, the fourth tip I have for your cash secured put strategy is to consider sometimes closing out the position early. Now, what do I mean by this? So let's say, let's go back to Amazon as an example. So let's say you sold the $90 puts for December 16th, 2022 a few weeks ago. And now, let's say you sold them for, I don't know, like $2. And now they're trading at 83 cents. And the options are going to expire in 3 days. And Amazon is trading at $92.53 right now. Well, in this case, I would consider potentially closing out the position early. So you're closing the position 3 days early, and you're basically leaving 83 cents off the table, but you already made, over $1 on the original trade. Now, the reason why you would sometimes want to close out a position early is if you expect something bad to happen in the news, and let's say the next few days before the option will expire, or if you just want to roll the option forward. So if it doesn't look like it's going to be exercised or anything like that, you could always roll it forward and sell it at the same strike, but a longer duration, or you could go down the option chain and do that as well. But if you've already generated a significant amount of the expected return of the option, it may be wise to just close the option out early, take the gains, and then roll forward the contract. Anyways, those are the 4 tips that I want to share with you guys regarding cash secured puts. Hopefully you found them helpful, and if you have any questions at all, please leave a comments down below.